Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. Do me a quick favor. If you like what you hear at Planet MicroCap, please take 2 seconds and give us 5 stars on Spotify or Apple. This helps with the search engine so that more folks can also discover and engage with all things microcap stocks. Our next investor conference is coming up, the Planet MicroCap Showcase Vancouver, on September 6 and 7, 2023 at the Fairmont Waterfront. We have companies, sponsors, speakers, all of that is up on the website at planetmicrocapshowcase.com. Those speakers include Dave Barr from Pender Fund, Harold Leishman and Brent Todd from Canaccord, Ryan Irvin from Keystone Financial, Hamed Shabazi from Well Health Technologies, and Paul Andriola from Small Cap Discoveries. Be sure to check out the website to learn more about the entire event, and it's not too late to register and attend. So once again, go to planetmicrocapshowcase.com. See you in Vancouver. My guest on the show today is Jonathan Boyar, president of Boyar Research. I recently saw Jonathan as a guest on the Value After Hours podcast with Tobias Carlisle and Jake Taylor and invited him on to get his perspective on the markets in 2023, as well as his take on microcap performance. As the title states, we've been experiencing a double whammy in microcaps, poor stock performance over the last 2 years, and allocators are not distributing funds to microcap strategists for the most part. We talk at length about why this environment is fertile ground for microcap investors that know what they're doing. Jonathan and I also talk about his latest venture, the Boyar Research Substack, where you can actually get Jonathan's latest microcap picks as a subscriber. The link to the Boyar Research Substack is in the show notes. So thank you again for tuning in to the Planet MicroCap podcast, and please enjoy my conversation with Jonathan Boyar. Jonathan, thank you for joining me today. How you doing, man?
Yeah, thanks for having me on the show. I'm excited.
Absolutely. I mean, look, we already we just met, but we were already kibitzing like we've known each other for years before we started recording. I was like, wait a second, we gotta hold the phone here, and we got so much to get into. Just I figured today for our pod, like we cover a ton of stuff. Like you've done some great stuff recently on other pods and like Value After Hours. I was just listening to that before we got on here. And also I think you did something on Yahoo Finance. So figured we'd kind of do an amalgamation of some of the things you hit on there and maybe some new stuff as well. So sound good?
Sounds good. Looking forward to it.
All right, let's do it. So let's start off with this, right? Because I mean, this wouldn't be a finance podcast if we didn't get your, overview on the state of the markets, right? Summer break's basically over. People heading back to the office, preparing for the final third of the year. What are you seeing as we head into the back half of the year here?
Yeah, well, hopefully the summer's not. You still have a couple of good weeks of weather, but yeah, no, I
from California, we always get good weather.
I get what you're saying. Listen, I think this year is a case in point where listening to strategists would have gotten you into so much trouble. Coming into the year, everyone was all doom and gloom. Everyone was unbelievably bearish. And if you listen to the so-called smart money, you would have missed out on a monster rally. And I think it's the textbook example of just stay the course, invest in good companies, and generally over a long period of time, good things will happen. So what's going to happen over the second half of the year? I have absolutely no idea. But The market at 18, 19 times earnings, it's not cheap, it's not expensive, but I don't invest in markets, I invest in stocks. To me, the cheapest area of the market by far is the micro and small part. I mean, that's almost undeniable and the best opportunity. But you have to be really, really careful. There's a lot of minefields out of there. About 45% of the Russell 2000 consists of unprofitable companies. But the opportunity there is enormous. I mean, I think if the Russell is about 20% above where it was 5 years ago, compared to the Nasdaq 100, which has just been ripped higher. Stocks in it are cheap, and no one cares about it. So to me, that's where the opportunity is, but you have to be patient.
100%. And like that was literally the one thing we were just talking about offline, because I mean, there's been, I can't tell you how many companies I've already talked to or interviewed over the last few months that have just been killing it, or maybe just reported their first profitable quarter. I mean, it's micro, right? So it might still be their first profitable quarter, and just no one cares. Absolutely nothing. And the one thing when I talk with other, fund managers that specifically have a microcap strategy is that we keep it's an interesting conversation, but it's also testing a lot of folks' patience as what will change here? When will not necessarily risk on come back, but when are people going to start to actually pay attention that half these companies are taking such a big haircut and yet they're performing, and actually start to care about that again? I'd love to hear your thoughts there.
Well, it's staying power. And one of the things, I was fortunate, my one of my favorite podcast guests ever was Ken Langone, the founder of Home Depot. And he was fantastic for a lot of reasons. But one of the reasons is he was talking about why he was so successful. And that was because he had staying power. Once he hit a certain amount of wealth, he didn't need to dip into his savings to, pay bills or whatnot. And he was able to just buy great companies and hold them for unbelievably long periods of time. Yeah, I could be wrong, I think, but I'm pretty sure I'm right. His biggest holding right now is not actually Home Depot. It's Eli Lilly, because he sold a company to it in I think the late 70s, and he's hasn't really sold much except probably gave away to charity. And just being able to have that staying power over time and to stick with a strategy that works and don't abandon it because it's not working. Just because something hasn't gone up doesn't mean it's not working. You have to reevaluate your thesis, obviously, and you have to be very humble and admit to know when you're wrong. But just because the stock price hasn't reacted doesn't mean your thesis is wrong.
Right. But to add to that, though, also, especially from an institutional side, from a fund side, I mean, the hard part is in talking with some of these firms is that you're not even seeing allocations going towards these strategies where, like, every book in the world will say, hey, if something's hated, at a minimum, take a look at it. When the sentiment is so negative in small micro and you're just not seeing any inflows, it blows your mind. It's just human nature just has a way of just always repeating itself.
Well, I think with micro, you have it's a double whammy. One, it hasn't done well, and two, people perceive it as risky, so they want any excuse not to invest in that. And this is a perfect excuse. No allocator is going to get fired for not investing in microcaps.
1,000%.
And that creates the opportunity. But going back to the patience, most people don't have it. And I'm confident, though, that 5 or 10 years from now, a good portfolio of microcap stocks will do quite well.
Absolutely. Well, I wanted to touch on one of your, I think it's called the MicroCap Funds, as part of the your research product within the Boyar Value Substack, right? Am I getting that correct?
Well, we have, okay. I guess to take a quick step back, we've been an institutional research provider since 1975. The firm was started by my dad, Mark, primarily to serve hedge funds, mutual funds, family offices, that sort of thing. And we've never really served the financial advisor, high net worth investor. So a couple of months ago, we launched a Substack. To do that, we have free articles and then a paid tier where we give them one stock idea a month, which we think is really cool. And one of the things that I was thinking of adding on to the Substack is about 10 years ago, we launched something called Boyar's MicroCap Focus, which same quality as our institutional product, but just on the smallest companies out there. And it was super unique, but it did really well in terms of the stock picks, but no one cared because people don't invest in that strategy. So what I think I'm going to do in the coming months is migrate that also coming onto our the Boyar Research Substack product. So it's trying to create as a few high quality products out there.
For sure. Well, I mean, look, listen, this podcast is not about giving your hottest picks or anything like that. But, in speaking of this new focus or this new offering that you're going to have within the Boyar Value Substack, maybe is there a little sneak preview or something that folks can kind of, I guess, look forward to if they were to subscribe to the MicroCap Focus?
Well, listen, there's a lot of opportunities in that in that area. We recently did a report on a company called Franklin Covey, which is a really interesting, sleepy little company based in Salt Lake City that's not particularly well covered. It's misunderstood, and names like that just not on Wall Street's radar, or something called like a Town Square Media, TSQ, which is a well-run legacy radio business. That is now turning into a digital kind of first company run by a guy named Bill Wilson, who's done a really good job. So there's names like that are off the beaten path. Some of them, like something like Town Square, people still think it's a radio business where majority of the EBITDA is digital and subscription based, and they're not in the top 50 radio markets to begin with. So you don't have to really worry about competition. Those are the types of names that we will look at, and it's amazing. Looking back through the years, we did like Martha Stewart a long time ago when it was a tiny company. It was $300-400 million, or some of these names, they're just small, and you can find great opportunities. We just recently did a company, Douglas Dynamic, ticker Plow. That's another interesting one, and that's actually on our Substack kind of behind the paywall. But basically, it's a snowplow company, and just because of the winters we've had, the stock's been depressed. But I think it's a well-run business with a solid balance sheet that we think will do well over the years.
Absolutely. So, and just to be clear, from a compliance perspective, TSQ, FC, Plow, are you? I'm assuming you guys are shareholders of these names. We own Town Square, and we own Franklin Covey. Got it. Okay, so not shareholders in Plow.
Not yet.
Very cool. All right. Well, it's funny you bring up Town Square. Like I'm not a shareholder, but that's come up on my screen actually for the last. We run an index here, Planet MicroCap Index, and I think they've been in there for the last 2 quarters, or either two of the last 3 rebalances that we've done. We rebalance on a quarterly basis, so that's one I've been trying to get that CEO on my due diligence series forever. Oh, maybe you can help me out with that at some point.
I might be able to. He's really trying aggressively to get the word out in a non-promotional way. He's done a good job, really good job transforming the business. So I'm happy to make the introduction. What's interesting is they've been opportunistic. We like good cap. Obviously, you make the most money either from really good capital allocators or really bad capital allocators, because bad capital allocators give you the opportunity to get things cheap. But for example, Madison Square Garden was a large shareholder. I think it was in the entertainment of Town Square, and they opportunistically bought back a large part of their shares from them. So they do smart things. They also instituted a dividend, and it's now an 8 or 9% yield because no one cares about the stock. And normally you get scared when you see 8 or 9% yields on companies, but this one we view as relatively safe. They're delevering, et cetera. But he's a good capital allocator.
Very good. So, another thing I'd love to ask you about this when thinking about the microcap focus and why folks should want to subscribe to this, because we're microcap podcast. So you knew I was probably going to be like, hey, this is the main thing that folks should be digging their heels into. But, you've alluded a little bit to what some of your criteria is, some of the things that you look for, especially when using those three as an examples. But maybe for giving a holistic look here, what are some of your criteria when you're looking at various companies to highlight in this microcap focus piece?
It's really the same as for our regular, what we look for. It's using the same methodology. The only difference would be we like, for the most part, to have large insider ownership in a microcap name, just because you're more apt to have frauds or things such as that. So you like to see the alignment of interest there. That would probably be the main difference. But just to backtrack, how do we find companies, or how do we look for companies? We take what we call a business person's approach to stock market investing. Essentially, we look at every company through the lens of an acquirer. What would Warren Buffett pay for the entire business? And that's the framework we do, and that's healthy to do on a town square media, where you can do kind of a sum of the part valuation there, and see what each business line is worth. And it's also healthy if you do a large company like Home Depot. It's good just to do that exercise to make sure that you're buying it at a significant discount to intrinsic value. We also are very catalyst focused. What's going to make the stock ascend in value over a reasonable period of time? Could the company be sold, which is often the case in microcap land? Could they spin out a division? Could they sell a division? Could they announce large buyback? There's lots of different things that we look for when doing that. And then we have a framework when we analyze companies. We look for hidden assets. Is there an asset on the company's balance sheet that's not properly reflected because of GAAP accounting? So it's there's lots of things to do.
Very good. Yeah, look at the main stuff that I think most folks that it resonates with that are probably listeners here. So, another question I had for you, not to jump around so much, but in hitting on some of the things that you answered earlier, that we're a family business here, Planet MicroCap. Boyar, you guys have family businesses. I think you said 1975. So, you said your father started it. Love to hear some thoughts on things that you learned from coming up in the business with your dad. Like I got those stories for days. So I love hearing them from other folks too.
Yeah, I mean, when it works well, which is in our case where it's worked well, it's fantastic. Obviously, there's horror stories too, and we have, fortunately, a great relationship, and I've learned a ton from him. And it's just it's a pleasure to be able to work with your family. And yeah, this is not a job for me. I mean, I grew up doing this. Like, this is how I view everything, through like kind of a business angle. And it just comes naturally to me, because these were the conversations we had around the dinner table, where I'd hear all these stories, which now I'm telling, which is kind of funny. Like, growing up, I used to hear, one of my dad's first big successes was company Tiffany, 1975. It was probably the sixth or seventh company he ever profiled. You could have bought the whole company for $30 million. So it was a microcap, then. And the building it owned on 57th Street was worth more than the entire market cap of the company. But because of GAAP accounting, that was not, easily discoverable, especially in the 1970s, where the biggest competitive advantage you have is like a calculator. There's no real screens to run. So you hear these stories, and it learning from history is extremely important.
100%. Yeah, I can only, you mentioned, we're fortunate too that we got the good rapport, but there's definitely you get those battles, man. That's for sure. And And it's okay because you're like, all right, this is with family. You can't have those battles don't work when you're not working with your dad or all that stuff. And but yeah, no, so I love that aspect of business. Like if you're able to have a family business and have that dynamic and be able to carry it on to the next generation and that kind of thing. So again, not to jump around a whole bunch here, but we alluded to talking about patience as an investor, especially at the top there when we were talking about the state of the markets. And you at Boyar Research on Substack, you guys put out this article, "You Make More Money Sitting on Your Ass," which is a great title. And the one thing I wanted there's 2 points from this article I wanted to discuss, and I think you have this visual here about the decline of long-term investing, and that is so appropriate, especially since March 2020, from the meme stock stuff, everything. Like that very much resonated with me, especially when you think about microcap investing, because most people come to me like, oh, like, trading and that kind of stuff. Do you kind of do that? It's like, no, not really. Like we try and have more of a long-term approach where you're building, having a lot more wealth creation and really digging deep into these companies. So in your opinion, why do you feel like there is this decline of long-term investing? It's just the next generation not listening? They're not, what's going on?
I mean, I think there's a lot of factors. One, it's, when my dad started the business in the 70s and we were a brokerage firm, they charged 30 cents a share or whatever it was for commission, which made you think twice about doing a trade. It's a great time to own a brokerage firm. But I think that's part of it. I think it's also, we're in a world of, not to make too much of a societal comment, of instant gratification, where everything's at the touch of a fingertip and a button. It's so easy to trade. It's free to trade. People are wired. I don't think people are wired to do nothing. They feel like they have to be doing something, and doing nothing is an action. And people always complain, especially on the investment management side, about fees and all that kind of stuff. But the biggest expense an investor pays, or at least in the US, if they're taxable, is to Uncle Sam. Every time you sell a stock, you have to, depending on your tax bracket, you have to, the value of your gain goes down by 25%. So you essentially have a 25% load on your profits. So that's in my mind, a huge bar to rejigger a portfolio. So you only really want to, when I do a calculus of, do I want to make a substitution on a position that has gain, I also have to think, is this new idea 25% better? And that's a high bar to have. So I think, patience is probably the most important part. Buying something at the right price, at a reasonable to good price, and having the wherewithal to stick with it are probably the two most important parts of investing.
100%. And I'm not sure what will change. You look at some of these statistics and I don't know. I'm not sure.
It's great.
Yeah.
For me, it's fantastic. That makes it, that gives us the opportunity. If everyone was, I read a book on Jim Simons or however, and at the end they said, the one area that the quants really have not gone after is long-term investing, because there's just you can't exploit that quantitatively. So when you have all these algorithms, buying and selling stocks in milliseconds, if you can have the ability to look out 3, 4, 5 years, that's a distinct competitive advantage. And there's very few of us left.
That's for sure. And this is where the idea of patience comes into play. I mean, for you, what have been some of the things that have helped you remain patient, and actually practice that approach when you say, okay, I'm dug in, I like this idea, I want to own this for 5, 10, 15 years. What are some of the things that you've been able to put into practice that have helped keep you, all right, I'm stay calm, I don't have to do something right now?
I think watching my dad growing up really helped, because he is, he's I'm not as patient as him. I'm trying, but he's unbelievably patient, and seeing that he was successful in doing that, and even though it hasn't worked as well recently, I know these things come in cycles. It gives me the confidence to be able to do that, and I think that's just kind of how I'm wired. And then I look at where have I personally made the most money. It's not been on trades that I held for 6 months. Some have been successful. It's been holding companies like Home Depot and Microsoft, which we've owned since the 2007, 6 or whatever, and just holding on through thick and thin. That's been the bulk of the game. So you just that's been the most helpful part of it. But you have to pick a style that you believe in and have the ability to that gives you the confidence to stay with it.
Absolutely. All right, so I'm about to take a full 180 transition to another topic. So I think it was on the Yahoo Finance interview that you recently did, where you talked about, I think it was that one. It might have been one of the other ones where you talked about the merits of investing in publicly traded sports franchises. And, rather than just talking specifically about sports franchises, this is something that's been coming up a lot. Like I listened to the Town podcast. It's a great show, very short episodes. And they've been talking a lot about, the selling, what should Disney do with ESPN, but really having to do with this one point that I've been wanting to talk about. I figured maybe we could bring it up here and see if you have some insight. It's having to do with sports rights. And the ZAG, I feel like, because everyone's just like, yeah, sports rights they just keep going up and up. Like, at what point are they going to be overvalued? When you think about, because at some point, one of the, whether it's a streamer or one of these legacy media companies are just going to be like, I don't want to pay that price. We're not, we don't have the cash to do that. Our business economics, it just makes no sense for us to keep paying these astronomical numbers. What are your thoughts there?
No, that's an excellent point, an excellent question. We started looking, I think it was 2012, 2013, we did a report on the value of sports media rights, and the two names that we did were Madison Square Garden and a company called ISCA, which was International Speedway, which owned race car tracks. So it's been something we followed for quite some time. It's been helpful. But yeah, no, I mean, Zaslav at Warner Brothers Discovery is someone who is price disciplined, but although he knows he needs the NBA, etc., the leagues need linear TV as much as it's a symbiotic relationship. I don't think it's healthy for the sports for everything to totally be over the top. Just on Amazon, just on Apple, etc. And I think for the foreseeable future, and a lot of these sports rights are locked up for quite some time. Amazon has a very different use case to get people on Prime than Warner Brothers Discovery. So I think it's going to be a mix. There's going to be some of these deals where it's going to be on Amazon Prime or Apple TV, et cetera, and some will be on traditional, media companies. Plus, I wouldn't rule out at some point in time traditional media. Maybe when we get a different regulatory environment, some of these big media companies fold into an Apple or Amazon or Google or whatnot. So it's moving pieces, but in today's world where people there's no real, you have DVRs, etc. Live sports and news are unbelievably valuable. And, this is also separate from the value of teams, which, obviously have benefited from the sports media rights. Those are just trophy assets. I mean, that's a completely different conversation in many respects, but you raise a really good point. At some point, behavior, price, changes things, and the demand's not totally inelastic.
Yeah, I mean, look, I'm a huge sports fan. I watch everything, and at a certain point, like when that conversation keeps coming up and you're thinking about these companies and they're losing money hand over fist, and yet here's the leagues coming to them saying, yeah, no, here's the price now. It's like, all right, we know you need us. We know you need the linear networks in order to keep the visibility up for the league. Like, why aren't you like, you got to come to at some point, and it just does. It hasn't really made a whole lot of sense. I mean, you're right. It's a little different than the sports franchise, but obviously they're the clear benefactors here, where everybody and their mother wants to go and own a sports franchise. Yeah. And I mean, pickleball, yeah. You know what I mean? Like, still, and there's no dig at pickleball, of course. Like, it looks like a lot of fun, but you know what I'm saying? Like, it blows my mind.
No, some of these numbers and what they're floating for the NBA renewal coming up in a couple of years, they're insane numbers, but these are live audiences that the broadcasters need. But yeah, it's not, at some point enough's enough.
Because I mean, the advertising is not, that revenue is not what it was, right? So like at the end of the day, something's got to give. I mean, I think that's most of the topics that I really wanted to cover here today. I mean, I guess to close this out, I mean, is there any final thoughts, looking at micro, small cap, just markets in general, anything in particular maybe you want to hit on here that we could, final thoughts?
No, the final thoughts are, I mean, I think really stick to a style that you're comfortable with, and that you can, invest in good times and bad times, and also, your own personal asset allocation. You don't want, everyone, on the money if I put on my money manager hat, people, or clients say, oh, they have huge risk tolerance. Everyone has a great risk tolerance till stocks go down. So you have to really take, careful of, what your exposure is, because you don't want to be someone who sells at the exact wrong moment. You don't want to be the person who realizes in March of 2020 that they have too much money in risk assets. And the other thing that's just worth at least mentioning or talking about, we're both young people, and I don't think people our age really should have much in the way of fixed income. But for the first time, at least in my career, stock, money markets and, short-term treasuries are legitimate, source of competition for stocks. And that's going to change dynamics, for the foreseeable future. I'm not someone who's going to opine on where interest rates are going to be. I have absolutely no idea, but it's something at least to take, into consideration. And if someone wants to, know more, I be happy, reach out to us or check out our Substack.
Very cool. All right. So yeah, with that, where can our audience go and follow you on social media? And then what's the Substack? It's just Boyar Research, right?
Yes, yeah, Boyar Research at Substack.com. And you can just follow us at Boyar, Boyar Value on Twitter. Those are kind of where we're, release most of our content. And this was great. Thank you so much for having me on the show.
Absolutely. It was great to have you. Thank you again. Good luck. Stay safe. And I look forward to our next update.
Thank you.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.